And welcome into Making Sense. You know, we've already finished the first quarter of 2016. Time flies when you're having a good time. You know, if you went to your medical doctor and he was going to examine your heart, you always like to see little ups and downs in your heart. But if it's going flat, you get kind of worried. But guess what's happening? The stock market's looking a little bit flat. So with us today is Brandt McDonald, Hagen Wealth Management. And Brandt,
right.
We want to know, what does that mean, that straight line? Because we're not seeing much activity, are we?
Yeah, well, you know what, Jack, I will tell you, if you rewind all the way back to October of 2014,
okay,
something significant happened. The Federal Reserve stopped quantitative easing.
Right.
They had created $4.5 trillion in new cash, took on a lot of assets onto their personal balance sheet. When they stopped that, it's no surprise to me, that's when the stock market began to flatline, as you say.
Right.
Now, it's not just a flat line, though. I mean, we've been going up and down for the last 18 months. It's been incredible volatility. You look at the first quarter of this year, you see it clearly. I mean, we started right out of the gate down. Probably 15% on the S&P 500. You know, we were getting a number of phone calls, not just from clients, but from people who are not clients, wanting to know what in the world is going on. And I think it's pretty telling. I mean, if you look at what is going on around the world, there's incredible amounts of debt and leverage in the system globally. Even in terms of dollar-denominated debt, we saw almost $17 trillion in new debt issued. In other words, the Fed's policies and other central bank policies, primarily the Bank of Japan, the European Central Bank, they have all embarked on this grand scheme to create trillions of new dollars, new euros, new yen in order to stimulate or reflate asset prices. That's creating a real problem, I think, in the world. It's causing assets to, or capital we should say, to find its way to places that it shouldn't be. And here the latest thing is you know, crude oil. I mean, if you monitor crude oil and look at what's happened, I mean, we hit $26 a barrel earlier in the year, and that created real panic in the financial services sector because a number of banks, primarily European banks, have incredible exposure to this to the new wave of oil-producing companies, particularly here in the U.S. Most of those business models, in terms of U.S. producers, was based on the idea that as long as we could maintain $50 a barrel oil, then these companies could break even or make a profit.
A little bit.
Well, $26 a barrel
is
not good. Not good for those new business models. So it put massive pressure and stress on European banks, and my goodness, let me tell you, Deutsche Bank back in February was almost brought to its knees. A lot of people were thinking this was another Lehman moment from the credit crisis. Of course, Mario Draghi with the European Central Bank, you know, brought out the fire hose and put that fire out very quickly. You know, it probably wouldn't be too beneficial to get too complex, but there's a whole new type of security that was created called COCO bonds, or contingent convertible securities. This whole massive wave of issuance of these type securities has really been called into question, and I think when you look at the risk premiums that we see that built in the system, it put a lot of stress on the financials, particularly in Europe. Here in the United States, it's started to become a little bit of a problem, although our banks are much more well capitalized. Even Jamie Dimon came out and said, you know, he's the big, you know, chairman and CEO at JP Morgan. He came out and said, yes, we're going to have to reserve against some non-performing loans, and if oil continues to go lower, we're going to get into the tens of billions in terms of reserves. The good news is our banks are well capitalized and they can handle it, but a lot of the European banks are not so well capitalized, particularly the southern, you know, the banks in the southern part of Europe. We're talking Portugal and Ireland and so on and so forth.
If you have debt, or if I have debt, we're concerned about it.
Right.
We address it, we try to do something. It seems like we always hear about debt, but it's kind of like, oh well, it's kind of like it's expected.
Right.
Is that the reality? Because
well,
eventually, if you're creating money, if it's not real money, it can't pay that debt, can
Right.
it?
Well, the way you get out of debt, if you have funded liabilities or unfunded liabilities, and you can't get out of debt, the way you do it as a sovereign government is to increase the money supply.
That's right.
And when you increase the money supply,
With
it causes
real money.
with real money,
Real money.
it causes the value of that currency to drop in value, and it causes the debt that you owe to become worth less. You know, when I speak, I give a great analogy of three people on an island. One has an iPhone, one catches the fish, and the other cuts the wood. Well, if we denominate that ecosystem, that economic system, in our local currency of only 10 special stones, let's say,
Right.
and my iPhone is worth 5 stones, and one day I go across the island and I find 90 other stones. I come back to the other side of the island. Now there are 100 stones in circulation. Well, if I owed the guy who caught the fish for me to eat, if I owed him 2 stones and I owed the woodcutter 2 stones and my iPhone was valued at 5 before I found the stones, my iPhone has not lost its utilitarian value.
Right.
I can still predict weather patterns and other things. Well, now it's not valued in 5 stones out of 10. It has to be valued in 50 stones out of 100.
Right.
Because the amount of our currency went up. It still does the same thing it always did. So in terms of asset valuation, if you charted it like a stock, it went from 5 to 50. So you get this mirage, this effect of, wow, I made a lot of money. But here's the interesting thing. What happens to the 2 stones of debt I owe the fisherman? It was 2 stones out of the 10 originally. Now it's 2 stones out of 100.
Okay, I'm going to have you come back next couple of weeks. We're going to talk about politics and how that may affect the market and, of course, your own pocketbook.
Yeah.
And we'll be right back right after this.